Welcome back, everyone, to the Deep Dive. This is where we really get into the nitty-gritty of financial reporting standards to help you nail those exams. We know you're juggling a lot, trying to study fast, but also deeply. So that's what we do here, pull out the absolute must-know info from your study materials, interactively. And hey, before we jump into today's topic, which is a big one, just a quick word. Practice is key, right? Especially for those tricky application questions. We've actually just launched our Copilot platform. It's built specifically for candidates like you, offers loads of exam-style multiple-choice questions at a really affordable price. It's perfect for drilling down on topics like today's. Check out the show description, the link's right there. Seriously, it's a great way to test yourself after this deep dive.
Okay, so today we are getting fully immersed in Module 7, Impairment of Assets. We're going through IAS 36, page by page, covering pages 375 to 412 in your guide. This standard is all about ensuring assets aren't overstated on the balance sheet. It involves quite a bit of judgment and, let's be honest, some pretty detailed calculations. It's definitely a high-stakes area for the exam.
Absolutely. And IAS 36, it all really hinges on one core idea, doesn't it? It's stated right up front in paragraph 1.
That's the bedrock, the carrying amount, basically, the book value of any asset, whether it's tangible, like PPE, intangible, like a brand, or even Goodwill. It simply cannot be higher than its recoverable amount. That's the fundamental rule.
The recoverable amount being what you can actually get back from the asset, either by using it or selling it.
Exactly. That's LO 7.1 in your guide. If the book value is higher than what you can recover, well, that asset is impaired. It's overstated. And you have to recognize an impairment loss immediately. It's all about protecting the users of financial statements from inflated asset values.
Okay, let's break that down then. Part A of the module starts with the basics, defining impairment and its impact. So, what exactly is this impairment loss in accounting terms?
It's pretty straightforward definition-wise. It's the difference, the amount by which the carrying amount, the CA, exceeds the recoverable amount, the RA. Your guide has a good example on page 376. Imagine you've got machinery on the books for $180,000. That's its CA. But maybe technology's moved on faster than expected or the market's changed, and now you can only realistically recover $80,000 from it.
Okay, so the difference, $100,000, that's the impairment loss.
Precisely. That $100,000 needs to be recognized.
And it's not just a paper adjustment, is it? It hits the books immediately.
Oh, absolutely. You make a journal entry. Debit impairment loss that hits your profit or loss statement as an expense, and credit accumulated impairment losses, which is like a contra asset account, reducing the asset's carrying amount on the balance sheet.
And it has flow-on effects too, right? For future depreciation.
Yes, that's crucial. Once an asset's impaired, its carrying amount is lower. So you have to reassess its remaining useful life, maybe its residual value, and adjust the future depreciation charges accordingly. Depreciation will generally be lower going forward because it's based on that reduced carrying amount.
It makes sense. Now, from a user's perspective, investors, analysts, why is impairment such a big deal? Page 377 touches on this. It sends signals, doesn't it?
It really does. A significant impairment loss can be a red flag. Users often see it as a sign that maybe management made poor decisions in the past.
Like paying too much for an asset in the first place, or maybe investing in something that just didn't pan out strategically.
Exactly. It can definitely shake confidence in management's capital allocation skills.
And it's not just perception. It directly impacts the numbers, the financial ratios everyone watches.
Oh, significantly. When you write down assets, your asset base shrinks. That can mess with key ratios like the current ratio, debt to equity, interest cover, sometimes making the company look riskier or less solvent than before.
And users get suspicious about the timing too, don't they? Is management taking a big bath, just writing everything off now to make future results look better?
That's always a question. Is it a genuine reflection of lost value, or is there some strategic timing involved? A sort of cleanup of the balance sheet. Users are definitely looking for that.
The Woolworths example in the guide example 7.1 is quite telling here. They took a $47 million impairment charge on their Metro food stores.
Yeah, and that wasn't necessarily about bad management decisions within Woolworths regarding those stores initially. It was largely driven by an external shock, COVID-19.
Right. Less foot traffic in city centers, changing shopping habits, things largely outside their control suddenly hammered the expected future cash flows from those specific stores.
And that's a vital point for you to grasp for the exam. Impairment isn't just about internal mistakes. It's a critical check against major shifts in the external environment. Market changes, economic downturns, new regulations that might make an asset suddenly worth less than its book value. It's about keeping the balance sheet relevant to current economic realities.
Okay, so that's the why. Now let's nail down the what. Which assets does IAS 36 actually apply to? The scope LO 7.2.
Right, scope is important. IAS 36 primarily deals with non-financial assets. That's the main category. And it's pretty broad within that. It applies to most of them, whether they're tangible like property, plant and equipment, PPE, or intangible like patents or brand names. It also doesn't matter if the asset is measured at cost or using the revaluation model unless it's specifically excluded by the standard.
So the big inclusions we need to remember are definitely PPE, intangible assets, goodwill from acquisitions.
Investment property that's carried at cost, not fair value. And importantly, these days, right-of-use assets from leases under IFRS 16.
And what about the key exclusions? Table 7.2 lists them. These are assets covered by other standards, right?
Generally, yes. If another standard already has specific rules for measuring an asset, often closer to current value, IAS 36 steps aside. So think inventories, that's IAS 2. Financial assets, they fall under IFRS 9. Deferred tax assets have their own rules. And investment property measured at fair value is also excluded because, well, its value is already marked to market.
Okay, clear enough. Now, definitions. Paragraph 6 of IAS 36 lays out terms we absolutely need to know cold for the calculations later.
These are non-negotiables. Run through them quickly. Carrying amount, CA. Simple enough. The amount the asset is recognized at on the balance sheet after deducting accumulated depreciation or amortization and any past impairment losses. Recoverable amount, ARA. This is the crucial one. It's the higher of two other values. Fair value, less costs of disposal, FELCSD, and value in use, VIU. You calculate both and pick the higher one. Value in use, VIU. This is the present value calculation. It's the PV of the future cash flows you expect to generate from continuing to use the asset in the business. Fair value. This definition comes from IFRS 13. It's the price you'd receive if you sold the asset in an orderly transaction between market participants. Think exit price. Cash generating unit, CGU. This one's key for later. It's the smallest group of assets you can identify that generates cash inflows mostly independent of other assets or groups. Think of a specific factory or a distinct retail store.
Got it. Those definitions, especially RA being the higher of FELCSD and VIU and the CGU concept, seem fundamental.
They absolutely are. You can't do the impairment test without them.
Okay, moving on to LO 7.3. When do we actually have to test for impairment? Doing this RA calculation looks time-consuming.
It can be. That's why IAS 36 has a kind of efficiency filter for most assets. It's a two-step process, generally.
Step 1 is?
Step 1. At the end of each reporting period, you have to assess if there's any indication that an asset might be impaired. This is like a screening test. You look for specific internal and external signals or triggers.
And if there are no triggers?
If there are no indicators, you stop. No need to do the full, potentially costly, recoverable amount calculation for that asset in that period.
Okay, so only if an indicator is present do you move to step 2.
Exactly. Step 2 is only triggered if step 1 suggests there might be a problem. Then and only then do you have to formally estimate the recoverable amount, ALA, and compare it to the carrying amount, ALA.
But as always in accounting, there are exceptions. Some assets must be tested every year, indicator or not. Page 379 mentions these. Why the special treatment?
It's because these specific assets are considered to have a higher inherent risk of being overstated, often because their value is more subjective or uncertain. IAS 36 paragraph 10 mandates an annual impairment test for 3 specific types.
And those are, gotta memorize these.
Absolutely. Number 1, intangible assets with indefinite useful lives. Think of a brand name that you expect to generate value forever, or a perpetual license. Since they aren't amortized, impairment testing is the only check on their value. Number 2, intangible assets not yet available for use. Like software development costs you're capitalizing but haven't finished or started using yet. Their future benefit is still uncertain. And number 3, goodwill acquired in a business combination. Goodwill can't be separated from the business it came with, and its value is very subjective, so it must be tested annually as part of its cash generating unit, or CGU.
So, for those 3 indefinite life intangibles not yet in use, and goodwill, it's a mandatory annual checkup no matter what.
Correct. The risk of overstatement is just considered too high to rely only on indicators.
Is there any shortcut, even for those?
There's a small potential relief mentioned in paragraph 24, specifically for indefinite life intangibles. If you did a detailed calculation in a previous period, and the RA was substantially higher than the CA, and nothing significant has changed since then
you might be able to carry forward that previous calculation.
You might, yes. But you'd need to document why it's still valid. It avoids redundant calculations, but requires justification. It's not automatic.
Okay, let's talk about those indicators then. the triggers for step 1 for all the other assets. Page 380 splits them into external and internal.
Right. Management has to consider, at a minimum, the list provided in the standard. Starting with external indicators, Table 7.4, these relate to the wider market and economic environment.
The most obvious one seems to be a significant drop in the asset's market value, more than you'd expect just from normal use or passage of time.
Definitely. If the market is suddenly valuing your asset type much lower, that's a big red flag. Then there are significant adverse changes in the environment. This is broad. It could be technological changes making your equipment obsolete.
Or market changes, like a new competitor slashing prices.
Yes, or changes in the economic climate, like a recession hitting demand.
Right.
Or even legal changes, maybe new environmental laws making your plant too expensive to run.
The third one is interesting. Increases in market interest rates or other market rates of return. How is that an indicator?
Because it directly impacts the value and use calculation. Remember, VIU involves discounting future cash flows.
Right.
Well, higher market interest rates generally mean you have to use a higher discount rate in that VIU calculation. And a higher discount rate mathematically reduces the present value of those future cash flows.
So higher interest rates push down the potential VIU component of the recoverable amount.
Exactly. It makes it more likely that the RA might fall below the CA. The standard does add a note of caution, though. Just because rates went up doesn't automatically mean impairment. You need to assess if the impact is material.
And the last external one, the company's net assets being higher than its market capitalization.
Yeah, that's a macro level check. If the stock market values the entire company, market cap, at less than the net value of its assets on the balance sheet.
The market's basically saying it doesn't believe the balance sheet values.
Pretty much. It suggests the market thinks the assets, in aggregate, might be overstated. It's a strong indicator demanding investigation.
Okay. Those are external factors. What about internal indicators? Table 7.5. Things closer to home.
These focus more on the asset's physical condition and how it's being used. First up is obvious. Evidence of obsolescence or physical damage. A machine breaking down or becoming technologically outdated.
Makes sense. What else?
Adverse changes in the extent or manner of the asset's use. For example, if an asset becomes idle for a long period, or if management decides to discontinue the operation the asset belongs to.
Or plans to dispose of the asset much earlier than originally expected.
Yes, or even restructuring plans that will significantly change how the asset is used. All these suggest the future economic benefits might be lower than previously thought.
And the big one, probably the most common internal trigger, evidence that the asset's economic performance is worse than expected.
Absolutely. This is crucial. Maybe the cash inflows generated by the asset are way below budget. Or, like in question 7.1a in the guide, the cash outflows, the operating costs, are significantly higher than budgeted.
Even if the asset is still making some profit.
Yes. Even if it's still in the black currently, if its performance is significantly worse than planned, it casts doubt on the future cash flow projections that underpinned its carrying amount. That negative variance is an internal indicator requiring a formal RA test.
And we should probably mention the regulatory angle here too.
Yeah.
Page 381 notes that bodies like ASIC are always focused on asset values, especially in uncertain times.
Definitely. Regulators expect companies to be realistic and properly consider all these indicators, especially external uncertainties like pandemics or major economic shifts. They want to see that management has rigorously assessed whether carrying amounts are still supportable. It's not just theory, it's a compliance hotspot.
Okay, so we've identified an indicator, or we're dealing with goodwill or an indefinite life intangible. Now we have to calculate the recoverable amount. This takes us to Part B of the module impairment of individual assets.
Right, and we repeat the core definition. RA is the higher of fair value, less costs of disposal, FELCSD, and value in use, VIU. You calculate both, compare them, and the higher value is your RA. Figure 7.2 illustrates this flow.
And the impairment loss is CA minus RA, but only if CA is higher than RA. If RA is equal to or greater than CA, no impairment, right?
Correct. If RA equals ECA, the asset is not impaired and you do nothing further.
Now, you mentioned inefficiency rule earlier. Can you explain that again in this context? It sounds important for exam strategy.
It really is. Since RA is the higher of FVLCSD and VIU, think about it. If you can determine one of those amounts, and that single amount is already higher than the asset's carrying amount, CA, do you need to calculate the other one?
No, because the RA will automatically be higher than the CA.
Exactly. So if you can easily get a reliable FVLCSD, perhaps perhaps from an active market quote, and that FELCSD is greater than the CA, you don't need to spend time on the potentially much more complex VIU calculation. You've already proven there's no impairment.
That's a great tip. Calculate the easier one first, if possible. Now, individual assets versus CGUs. When can we test an asset by itself?
The default preference in IAS 36 is always to determine the RA for an individual asset if possible. This works well if the asset generates cash flows largely independently. Think of a standalone lentil building, for example. But many assets don't work in isolation, like a single machine on a production line. It doesn't generate cash inflows on its own. Its value comes from working with all the other machines.
So that machine would have to be tested as part of the whole production line, the CGU.
Generally, yes. If an asset doesn't generate independent cash flows and its VIU can't be estimated as close to its FELCSD, or FELCSD isn't measurable, then you must test it as part of the smallest CGU it belongs to. We'll cover CGUs in detail in Part C.
Okay. Let's assume for now we can test individually. We need to calculate FELCSD and VIU. Let's start with FELCSD.
Fair value less costs of disposal. The fair value part comes from IFRS 13, the price in an orderly sale. The tricky part is often the less costs of disposal.
What counts as a cost of disposal? Page 385 gives some guidance.
The key word is incremental. These must be costs directly attributable to the disposal, costs you would only incur if you actually sold the asset.
So things like legal costs for the sale contract, stamp duty, maybe removal costs to get the asset ready for the buyer.
Yes, those are typical examples listed in Table 7.6. Costs to dismantle it, transport it if that's part of the deal.
But the exclusions are just as important, aren't they? What definitely doesn't count.
Right. You absolutely exclude finance costs, you exclude income tax expenses related to the sale, and critically, you exclude costs associated with restructuring or winding down the related activity after the disposal. For example, employee termination benefits paid to staff who worked with that asset.
Why are termination benefits excluded? It feels like they're related to getting rid of the asset.
They're related to the decision to cease the activity or dispose of the asset, but they aren't a direct cost of the transaction of selling the asset itself. IAS 36 draws a hard line here. They are considered subsequent operational costs, not disposal costs deducted from the sale price.
Let's use example 7.3, the dredging equipment. Sale price $1 million. Costs listed are levies, $15K, dismantling $15K, legal fees $12K, termination benefits $30K, and evaluation fees $7K.
Right.
How do we calculate FELCSD?
Okay, start with the $1 million fair value, then deduct only the direct incremental costs of disposal. That's the levies, $5K, the dismantling $15, and the legal fees, $12K. Total deductions, $32,000.
So FELCSD equals $1 million, $32,000, it was $968,000.
Correct.
And the termination benefits, $30K, and the valuation fee, $7K, are excluded.
Absolutely excluded. The termination benefits are out for the reason we just discussed.
Yeah.
And the valuation fee. You incurred that cost to determine the fair value, not to actually make the sale happen. It's not an incremental cost of the disposal transaction itself. That distinction is crucial.
Got it. Incremental cost directly tied to the act of selling. Okay, that's FELCSD. Now for the potentially trickier one. Value in use, VIU.
Ah, yes, VIU. This is where significant judgment comes in, as page 386 highlights. It's the present value of future cash flows from the asset's continued use and its ultimate disposal.
So two main steps involved. Estimate the cash flows, then discount them back to today's value. Let's start with step 1, estimating future cash flows.
This is complex. IAS 36 paragraph 30 lists 5 elements you need to consider. 1, the estimates of the future cash flows themselves, inflows and outflows. 2, expectations about possible variations in the amount or timing of those flows. 3, the time value of money, handled by the discount rate. 4, the price for bearing the uncertainty inherent in the asset, risk premium, also often in the discount rate. 5, other factors like illiquidity.
How do we deal with the uncertainty part, point 2 and 4? The guide mentions 2 approaches on page 387, 388.
Right. There's the traditional approach, example 7.4. Here you typically estimate a single best estimate or most likely cash flow for each future period. Then you build the adjustment for risk and uncertainty primarily into the discount rate, using a higher rate for riskier cash flows.
Okay, so simpler cash flow estimate, more complex discount rate. What's the other way?
The expected cash flow approach, example 7.5. This is arguably more sophisticated and conceptually often preferred by IFRS. Here, you estimate several possible cash flow scenarios for each period, assign a probability to each scenario, and calculate a weighted average cash flow for that period.
So the risk adjustment is partly done within the cash flow estimate itself by weighting the possibilities.
Exactly. Because you've probability weighted the cash flows, the discount rate you use might then be closer to a risk-free rate, or at least have a smaller risk premium compared to the traditional approach. It's more complex to apply, but can give a more nuanced picture of uncertainty.
Whichever approach you use, IAS 36 has strict principles for the estimation itself, doesn't it? Page 389.
Yes, very strict. The assumptions underlying your cash flow projections must be reasonable and supportable. Management needs to use its best estimate, but importantly, give greater weight to external evidence where available. Internal optimism needs to be tempered by market realities.
And there's a limit on how far ahead you can project.
A crucial limit. The detailed forecast period is generally capped at 5 years. You can project further if, and only if, you can strongly justify it based on reliable evidence. But the default is 5 years.
What about cash flows beyond that 5-year detailed forecast? Example 7.6 seems to cover this.
For periods beyond the detailed forecast, called the terminal value period, you have to extrapolate using a steady or declining growth rate. And crucially, that growth rate cannot exceed the long-term average growth rate for the products, industry, or country the asset operates in. This stops companies projecting unrealistic, perpetual high growth to inflate the VIU.
That makes sense. What about which cash flows to include or exclude? Page 390-391. We need to include inflows from using the asset.
And the necessary cash outflows to generate those inflows. This includes day-to-day operating costs and also routine maintenance or capital expenditure needed just to keep the asset operating in its current condition.
But what about major upgrades or enhancements?
Excluded. Paragraph 44 is clear. You exclude cash flows related to future restructurings that the entity isn't yet committed to. And you exclude cash flows expected from improving or enhancing the asset's performance beyond its current state. The VIU is based on the asset as it is today.
Okay, maintain current condition included, enhanced performance excluded. What about financing and tax?
Also strictly excluded. Paragraph 50 says you must exclude cash inflows or outflows from financing activities, things like loan principal repayments, interest payments, lease payments.
And income tax receipts or payments are also out. Why exclude tax? Doesn't the company get tax deductions like depreciation related to the asset?
Yes, they do, but there's a critical reason for excluding both financing and tax cash flows from the VIU calculation. It's all about consistency with step 2, the discount rate. Financing cash flows depend on the company's capital structure, not the asset itself. Tax cash flows depend on the company's overall tax position and specific tax rules. By excluding them, we aim for a VIU that reflects the asset's underlying operational cash-generating ability, independent of how it's financed or taxed.
And this links to the type of discount rate we use.
Precisely. Because we exclude financing and tax cash flows, which are post-tax and funding structure dependent, we must use a pre-tax discount rate in step 2 that also ignores the company's specific financing and tax situation. It keeps the comparison consistent.
The consistency point comes up again with inflation too, doesn't it? Figure 7.3.
Absolutely vital. You have 2 choices. 1, estimate cash flows in nominal terms, including the effect of general inflation, and use a nominal discount rate, which also includes an inflation component. 2, estimate cash flows in real terms, excluding general inflation, and use a real discount rate, inflation stripped out. You must be consistent. Using nominal cash flows with a real discount rate, or vice versa, will give you a meaningless VIU. Pick one basis and stick to it for both cash flows and the rate.
Okay, that covers estimating the cash flows. Now for step 2, determining the discount rate. We know it has to be pre-tax. What else?
Paragraph 55 defines it. The discount rate must reflect current market assessments of 2 things. 1, the time value of money, essentially the risk-free rate. 2, the risks specific to the asset for which the future cash flow estimates have not already been adjusted.
That last part is key. Avoid double counting risk.
Exactly. If you use the traditional cash flow approach, single best estimate, your discount rate needs a higher risk premium to capture the uncertainty. If you use the expected cash flow approach, probability weighted, the cash flows already reflect some uncertainty, so the risk premium and the discount rate should be lower. Consistency, again.
Finding a rate specific to one particular asset sounds difficult in practice. Page 393 mentions using surrogates.
Often necessary. It's rare to find a market rate for, say, one specific machine. So entities often start with a surrogate, like their weighted average cost of capital, WACC, their incremental borrowing rate, other market borrowing rates.
So these are usually entity-level rates, aren't they? And often post-tax.
Correct. So you can use them as a starting point, but they usually need significant adjustment. You need to adjust WACC to be pre-tax, and crucially, you need to adjust any surrogate rate to reflect the risks specific to the asset being tested, which might be different from the company's average risk profile.
And the rate must be independent of the company's capital structure.
Yes, consistent with excluding financing cash flows. The VIU is meant to be an intrinsic operational value, not dependent on whether the asset was financed with debt or equity.
Okay, that VIU calculation is definitely involved. So
Yeah.
we've calculated RA, higher FEL, CSD, and VIU. We compare it to CA. If RA is less than CA, we have an impairment loss. How do we recognize it?
For most assets carried at cost, the impairment loss, CIRA, is recognized immediately in profit or loss, P&L, as an expense. Simple as that.
But there's an exception for revalued assets.
Yes. If the asset is carried under the revaluation model, like some PPE under IAS 16, the accounting follows the revaluation rules first. The impairment loss is first treated as a revaluation decrease. So you recognize it in other comprehensive income, OCI, to the extent that it reverses a previous revaluation surplus held in equity for that specific asset.
And if the impairment loss is bigger than the existing revaluation surplus for that asset,
Then the excess amount, the part that can't be offset against the surplus in OCI, goes to P&L. After the impairment, future depreciation is based on the new reduced carrying amount.
okay, that covers recognizing the loss. What about reversing it later? Can impairment losses be reversed if the asset's value recovers? LO 7.4 again.
Yes, they can be, except for goodwill. For other assets, at each reporting date, you have to assess if there are indications that a previously recognized impairment loss might no longer exist or might have decreased.
What kind of indications? Maybe the market conditions that caused the impairment have improved significantly.
Exactly. Or maybe interest rates have dropped, boosting VIU, or the asset's economic performance is now much better than expected. If indicators exist, you re-estimate the recoverable amount, RA.
And if the new RA is higher than the current impaired carrying amount.
Then you recognize a reversal of the impairment loss. However, and this is a critical exam point, there's a strict cap on how much you can reverse.
The cap is the lower of two things.
Correct. The reversal increases the carrying amount, but only up to the lower of 1, the asset's newly calculated recoverable amount, the current RA. 2, what the asset's carrying amount would have been if no impairment loss had ever been recognized in the past, i.e., its historical cost less the depreciation it would have accumulated without any impairment.
Example 7.9 illustrates this. Why the cap?
The cap, point 2, prevents you from recognizing a reversal that effectively takes the asset's value above its depreciated historical cost. Reversing an impairment shouldn't create a gain beyond restoring the previous write-down, adjusted for depreciation that would have occurred anyway.
So you can reverse the loss, but only back up to where the asset would have been on a depreciated cost basis if you'd never impaired it.
Precisely. You calculate that would have been carrying amount, compare it to the new RA, and the lower of those two becomes the new carrying amount. The difference between that and the current impaired CA is the reversal gain, recognized usually in P&L unless it relates to a revalued asset where it might go to OCI first.
Okay, that cap is crucial. Now, you mentioned an exception, the goodwill constraint.
Yeah.
Page 395 makes this very clear.
Yes, this rule is absolute. An impairment loss recognized for goodwill must never be reversed in a subsequent period. IAS 36, Para 124.
Never. Why not?
It comes down to the nature of goodwill and the rules in IAS 38 on intangible assets. Goodwill represents future economic benefits from assets acquired that aren't individually identifiable. If the value of the business, the CGU, increases after goodwill was impaired, it's considered impossible to reliably distinguish whether that increase is a recovery of the original purchased goodwill or if it's due to new, internally generated goodwill created by the business since the impairment.
And IAS 38 prohibits recognizing internally generated goodwill.
Exactly. So, to avoid recognizing prohibited internally generated goodwill, IAS 36 takes a hard line. Once purchased goodwill is impaired, it stays impaired. Any subsequent increase in the CGU's value is deemed internally generated. No reversals allowed for goodwill. Full stop.
That's a major point to remember. No goodwill reversals, ever.
Definitely lock that one away.
All right, that covers individual assets pretty thoroughly. Now we need to tackle Part C, impairment of cash-generating units, CGUs, and goodwill. This is where assets don't work alone.
Correct. When an individual asset doesn't generate largely independent cash inflows, we need to assess impairment at the CGU level. Remember the definition. the smallest identifiable group of assets that does generate largely independent cash inflows.
Identifying the CGU itself seems like it requires judgment. Page 399 suggests looking at how management monitors the business.
That's often the starting point. How does management review performance? By individual stores, by product lines, by geographical region. That level of internal monitoring often corresponds to the CGU level because that's how cash inflows are tracked and decisions are made.
But there's also the active market rule on page 399, even if output is used internally.
Yes, that's an important override. Imagine a company division that makes a component. Maybe 80% of its output is used by another division within the same company, internal transfer. But if there's an active external market for that component,
Where the division could sell it to outside customers.
right, if that active market exists, then that component-making division must be identified as a separate CGU, even if most of its sales are internal. The existence of the market price provides an independent benchmark for its cash-generating ability.
And if it's identified as a CGU, its VIU calculation would need to use market prices for those internal transfers.
Exactly. Arm's-length pricing would be required for the VIU calculation to reflect its independent earning capacity.
Okay, so we've identified the CGU. Next, we need its carrying amount. Figure 7.5 suggests it includes directly attributable assets, reasonably allocated assets, and goodwill.
That's generally right. You sum up the carrying amounts of 1. Assets that directly belong only to that CGU. 2. A portion of any shared assets, like corporate assets, that can be allocated on a reasonable and consistent basis. 3. Any purchased goodwill that has been allocated to that CGU.
What about liabilities? Page 401 says we generally exclude them.
Correct. The standard impairment test compares the RA of the assets to the CA of the assets. So liabilities are normally excluded from the CGU's carrying amount for this test.
But there are 2 exceptions where liabilities are considered.
Yes, 2 specific situations. 1, if disposing of the CGU would require the buyer to assume a specific liability, like a site restoration provision tied directly to the CGU's assets. In this case, the liability is deducted from both the CGU's CA and its recoverable amount, specifically from both FVL-CSD and the VIU cash flows. 2, if the CGU's recoverable amount cannot be determined without considering certain related liabilities or assets. Think of working capital items like trade payables that are inseparable from the CGU's operations. If you need to include them to get a sensible RA, then you also adjust the CA accordingly, but this is less common.
Okay, excluding liabilities is the general rule.
Yeah.
Now, allocating those shared assets, goodwill and corporate assets. Let's start with goodwill. Page 401.
Purchased goodwill from an acquisition doesn't generate cash flows on its own. It must be allocated from the acquisition date to each CGU, or group of CGUs, that is expected to benefit from the synergies of the combination.
And how granular does that allocation need to be?
It must be allocated to the lowest level within the entity at which management monitors that goodwill for internal management purposes. So if management tracks goodwill benefits at the individual store level, you allocate it there.
But there's an upper limit on the size of that unit.
Yes. The CGU, or group of CGUs, to which goodwill is allocated cannot be larger than an operating segment as defined by IFRS 8 reporting operating segments. This stops companies from allocating goodwill too broadly, which could hide impairment within smaller, underperforming units within a larger, profitable segment.
What if you later sell off part of a CGU that had goodwill allocated to it?
Then a portion of that allocated goodwill needs to be derecognized, essentially included in the carrying amount of the operation being sold. This is usually done based on the relative values of the part sold versus the part retained, unless another method is more appropriate.
Okay, that's goodwill.
Yeah.
What about corporate assets? Page 403. These are assets like the head office building or central IT systems that benefit multiple CGUs.
Right. They don't generate their own independent cash flows, and they often serve many parts of the business.
How are they handled in CGU impairment testing?
First, you try to allocate the corporate asset on a reasonable and consistent basis to the individual CGUs it supports. If you can do that, EGOJ may allocate the head office building based on floor space used by each division's admin staff located there. Then that allocated portion is included in each CGU's carrying amount for its impairment test.
But what if you can't reasonably allocate it? Like a central research lab that benefits everyone unpredictably?
If the corporate asset cannot be reasonably allocated, IAS Thumb 6 requires a 2-stage testing approach. Stage 1. You test each individual CGU for impairment without including any allocation of that unallocable corporate asset. Recognize any impairment loss just for the CGU itself first, writing down its goodwill, then its other assets pro rata. Stage 2. After testing the individual CGUs, you then need to perform a second impairment test at a higher level. You identify the smallest group of CGUs that includes the CGU under review and to which the corporate asset can be reasonably allocated.
So you test the individual CGU first, then test a larger group, including the corporate asset.
Exactly. You compare the carrying amount of that larger group, including the corporate asset, to the recoverable amount of that larger group. Any impairment loss found at this higher level is allocated according to the normal CGU rules. Goodwill first, then other assets pro rata across that larger group, but you don't double count losses already recognized in stage 1. This ensures all assets, including corporate assets, are covered by the impairment test somewhere.
That makes sense. It's a way to capture the impact of those unallocable assets. Okay, now the main event for CGUs. The impairment test and loss allocation itself.
Right. Remember, CGUs containing goodwill or indefinite life intangibles must be tested for impairment at least annually, and whenever there's an indicator of impairment, para 90.
So we calculate the CGU's recoverable amount. As a whole, it's FELCSD or VIU, and compare it to the CGU's carrying amount, including allocated assets and goodwill. If CARA, we have an impairment loss for the CGU.
Correct. Let's say the CGU's CA is $1 million, its RA is $800,000. We have a $200,000 impairment loss to allocate among the assets within that CGU.
And the allocation isn't just straight pro rata, is it? There's a specific order mandated by IAS 36, paragraph 104.
A very specific non-negotiable order. Because goodwill is considered the most vulnerable asset, the buffer paid in an acquisition. Step 1. The impairment loss must first be allocated to reduce the carrying amount of any goodwill allocated to that CGU.
So if our CGU had $150,000 of goodwill and the total loss is $200,000, we first wipe out that $150,000 of goodwill.
Exactly. Goodwill goes down to zero. That uses up $150,000 of the loss.
We still have $50,000 of the loss left?
Yeah.
200K, 150K. What happens now?
Step 2. The remaining amount of the loss, $50,000 in this case, is allocated to all the other assets in the CGU, PPE, intangibles other than goodwill, etc., on a pro rata basis, based on their carrying amounts before this impairment allocation.
Okay, so you look at the carrying amounts of all the non-goodwill assets, sum them up, calculate the proportion each represents, and allocate the remaining $50K loss accordingly.
Precisely. If asset A makes up 60% of the non-goodwill CA, it gets 60% of the $50 loss allocated against it. If asset B is 40%, it gets 40%.
But there's another crucial constraint here, isn't there? The individual asset floor on page 405.
Yes. This is probably the most complex part of the allocation and a common exam trap. When you're doing that pro rata allocation in step 2, you cannot reduce the carrying amount of any individual asset within the CGU below the highest of 3 things. 1, its own fair value, less costs of disposal, FELCSD if you can measure it. 2, its own value in use, VIU, if you can determine it, which might be 0 if it can't be used alone. 3, 0. Obviously, you can't go negative.
So in our example, let's say asset A's share of the $50K loss is $30K. But we know asset A has a measurable FELCSD of, say, $40,000, and its current CA, after allocating the loss, would drop to $35,000. We can't do that.
Correct. You can only write asset A down to its floor, $40,000 in this case, assuming 40K is the highest of its FELCSD, VIU, and 0. You can't take it below that individual recoverable amount.
So the loss allocated to asset A is capped. What happens to the portion of the loss that couldn't be allocated to asset A because it hit its floor?
That unallocated portion of the loss gets reallocated. It has to be absorbed by the other non-goodwill assets in the CGU, those that haven't hit their individual floor yet, again on a pro rata basis based on their carrying amounts.
Wow, okay, so it can get iterative. You allocate, check the floor if an asset hits the floor. You reallocate the shortfall to the remaining assets, check their floors, until the entire CGU impairment loss is allocated without breaching any individual asset's floor.
That's the process. Example 7.11 in the guide walks through this reallocation. It's really worth studying carefully.
And just to clarify, other intangible assets within the CGU, like patents or licenses, not goodwill, they participate in that step 2 pro rata allocation.
Yes, they do. They aren't treated like goodwill, allocated first. They're part of the other assets group in step 2. And importantly, unlike goodwill, impairment losses allocated to these other intangible assets can potentially be reversed later if the CGU's value recovers, subject to the usual reversal cap.
Okay, that CGU allocation logic, goodwill first, then pro rata, subject to the individual asset floor, is absolutely critical.
Master that, and you've mastered a huge chunk of IAS 36 application.
Right, final section, Part D, disclosure requirements. After all these calculations and judgments, what do we need to tell the users? LO 7.4 and 7.5 cover this.
Transparency is key, especially given the subjectivity involved. IAS 36 mandates extensive disclosures falling into two broad categories, page 410.
Category 1 seems straightforward. Disclosures about actual impairment losses recognized or reversed during the period.
Yes, for each material impairment or reversal, you need to disclose the amount recognized in P&L and/or OCI, the line items affected. For individual assets, the nature of the asset and the event circumstances leading to the impairment or reversal, your decline in market demand, technological change. Whether the recoverable amount was based on FEL-CSD or VIU. If VIU was used, you generally need to disclose the discount rate used.
So users can see what got impaired, why, and how the RA was measured. Makes sense. What's Category 2? Page 411 focuses on this.
Category 2 involves more detailed disclosures about the estimates used to measure the recoverable amounts of CGUs that contain significant amounts of goodwill or indefinite life intangible assets.
Why the extra detail for these CGUs?
Because these are considered the highest risk areas, relying heavily on long-term forecasts and subjective assumptions. Regulators, like ASIC, pay very close attention here. Users need more insight into how those recoverable amounts were derived.
So what extra information is needed for these high-risk CGUs?
You need to disclose the key assumptions management used in the cash flow projections for VIU, or the key inputs for FVL-CSD if that was used. This includes things like the discount rates applied, the forecast period lengths, the growth rates used to extrapolate beyond the detailed forecast period, any other assumptions that have a significant risk of causing a material adjustment within the next year. For example, assumptions about sales volumes, prices, raw material costs.
And the crucial sensitivity analysis.
Yes, this is vital, especially if the CGU's recoverable amount isn't substantially higher than its carrying amount, i.e. it's close to being impaired. The standard requires disclosure of how sensitive the calculated recoverable amount is to reasonably possible changes in key assumptions. For example, if the discount rate increased by 1%, the recoverable amount would decrease by $6, resulting in an impairment of dollars. Or if the long-term growth rate decreased by 0.5%, the headroom would be eliminated.
So it shows users the margin of safety or lack thereof.
Exactly. It gives them a feel for how robust the valuation is and how close the company might be to recognizing an impairment loss if conditions change slightly. It's critical transparency for risk assessment.
That makes a lot of sense. Okay, we've covered a huge amount of ground there. Let's try and boil it down. What are the absolute key takeaways from this IAS 36 deep dive?
All right, let's crystallize maybe 5 crucial points for exam success. 1. Core principle and RA. Carrying amount cannot exceed recoverable amount. RA is always the higher of fair value, less cost of disposal, FEL-CSD, and value in use, VIU. Remember that efficiency rule calculate only what you need to prove RACA.
2. Testing triggers. Most assets are tested only if indicators are present, the screen test. But remember the mandatory annual test for goodwill, indefinite life intangibles, and intangibles not yet in use regardless of indicators.
3. VIU calculation rigor. This needs precision. Use pre-tax cash flows, exclude financing and tax impacts, and match with a pre-tax discount rate. Be consistent with inflation. Respect the 5-year forecast cap and the limit on terminal growth rates. Only include cash flows for the asset in its current condition.
CGU allocation order. This is vital. If a CGU is impaired, the loss hits goodwill first, down to 0. Any remaining loss is allocated pro rata to other assets. But crucially, no individual asset can be written down below its own floor, highest if it's FEL-CSD, VIU, or 0. Remember the potential for reallocation if an asset hits its floor.
5. Reversals and goodwill. Impairment losses, except for goodwill, can be reversed if conditions improve, but the reversal is capped at the asset's carrying amount had no impairment ever occurred, depreciated historical cost. And reiterate, goodwill impairment can never be reversed.
That's a fantastic summary. It really highlights the interplay between the rules and the judgment required.
Absolutely. Mastering IAS 36 isn't just about memorizing steps. It's about understanding the why behind the rules, why goodwill is treated differently, why the PAPs exist, why certain cash flows are excluded. That understanding is key for applying it correctly in complex scenarios.
It really forces you to critically evaluate management's assumptions about the future, doesn't it?
It does. It requires professional skepticism. Are these cash flow projections realistic? Is the discount rate appropriate given the risks? Applying this standard properly is a core skill for financial reporting professionals.
Well, that brings us to the end of this deep dive into IA36 impairment of assets. A huge thank you to you, the listener, for sticking with us through this detailed exploration. We hope it's clarified some complex areas. If you found this helpful, maybe share it with fellow students or colleagues who are also on this study journey. And don't forget, putting this knowledge into practice is essential. Do check out the CPA Copilot platform link in the show notes to test yourself with exam-style MCQs on this and other topics. It's a really effective way to solidify your understanding. We also really appreciate any support you can offer, perhaps through Buy Me a Coffee, again, link in the notes. It helps us keep creating this detailed content for you. Please subscribe too, so you don't miss future deep dives.
Keep up the hard work, focus on understanding the principles, and practice those calculations.
Until next time, keep studying smart, and we'll see you in the next episode.